Hello, this is Opusai Thakuri and my student ID is EMB80811. So I'm gonna start a presentation in the subject accounting. So I have chosen the company a National Australia Bank. And so I have chosen their annual report of the year 2018 and 2019. So this report mostly focuses on the tax related activities of the NAV and some of the different terms of the accounting like taxable profit, temporary differences, deferred tax liabilities, etc. So let's start with the question number 1. So accounting profit. So accounting profit is also known as the financial profit, which is the total earning of the company according to the GAAP. So it also include the explicit costs like interest, tax. So let me give the example. If the company ABC earn like 10 million a year and its normal expenses is 6 million a year, with its tax expenses is 3 million a year, and the depreciation and the operating cost, then let's say that. So as a result, the accounting profit is gross revenue minus expenses. So the gross revenue is a $10 million minus all the expenses. The result is a accounting profit. Okay, so another one is the taxable profit. So it is a profit in which the tax is liable to pay. The final profit where the tax is calculated from that amount, and that amount we need to pay it as a tax. So earned and unearned income both is included in the taxable income. Okay, and another one is temporary difference. So what is temporary? It is a difference between the financial accounting and tax accounting, in which the accounting income is subjected to tax, could be higher or lower than the taxable income. So that is a temporary difference. We had two types of temporary difference. One is taxable and one is deductible. So the taxable temporary difference is an amount that will be held taxable income in future to determine taxable profit or loss. Let me give you an example. If the company purchased a long-term assets of $5,000, so in some country there is no tax, there is no deduction of tax on use of assets or its disposal. Hence, there is a taxable temporary difference of $5,000. So that is a taxable temporary difference. And another one is deductible temporary difference. So the temporary difference is an amount that will be deducted in the future, so when calculating taxable income or loss. So for an example, if company purchases assets of $6,000 and the taxable amount of an asset is $8,000, so there is a deductible temporary difference of $2,000. Okay, and another term is deferred tax assets. So it is an item which may be used to deduct taxable income in future, is known as deferred tax assets. So it occurs when the company overpaid taxes and paid in advance. Then after that, the deferred tax assets will be arise. Let me give you an example. If the company faces loss in the year, company uses that loss in the upcoming year just to reduce its taxable income, so that they need to pay less taxes. So NAV, the company, I have chosen company NAV, National Australia Bank. So it has $2021 million as a deferred tax assets. So and deferred tax liabilities. So deferred tax liabilities is a tax which is need to be paid in this year but still not paid. So the difference will arise at the time of the payment. So that is the deferred tax liabilities. And there's a question number 2, how the recognition of deferred tax assets is done. So when there are deficient taxable differences related to the same taxation authority, a deferred tax is recognized. Okay, so another point would be that in the period to which an tax loss emerging from the deferred tax assets can be conveyed back or forwarded. Okay. And another is recognition of deferred tax liabilities. So deferred tax liabilities should be recognized the taxable temporary difference when there is difference between tax base of assets or liabilities and its carrying amount. Okay, so let me give you an example of accumulated depreciation. It will be less in assets than the cumulative depreciation, but in future it will generate, obviously it will generate a taxable profit. Okay, so the question number 3, the NAV has of 1,644 million as a tax expenses in the year 2018 and 1,273 million dollar taxes in expenses in 2019. So as a result, it has been decreases from 2018 to 2019 by 371 million dollar. Okay, and let's go to the question number 4. Yes, no, the figure is not same. The figure that is in tax expenses should be 30% of the profit, uh, 37 of the profit, and that is not same because the profit is 4,522 million dollar. That 30% of that is equals to 1,366 million dollar, but that there is written, there is the income tax, there is written that as a tax expenses 1,273 million dollar, because there are some of the terms that need to be added or less, like foreign tax exchange rate difference, offered banking unit income, losses not tax affected. There are some of the terms that I need to add and less, which is in the annual report. So at the final, the total will be like 93 million less. So the 30% of the main profit is 1,366 minus 93 million dollar is equal to 102,073 million dollar. Hence, it's proved. Okay, so another number is question number 5. In this year 2019, deferred tax assets is recognized and recorded 2021 million, and there's no deferred tax liabilities at the time. Okay, and there are some of the deferred tax liabilities, there are some of the deferred tax deferred tax assets like employment entitlements, depreciations, and collective provision of credit impairment. There are some of the deferred tax assets, but the company did not record any deferred tax liabilities in 2019. So, and the question number 6, they have not recorded any current tax assets in 2019, but in 2019 they had recorded 82 million as a current tax assets, and the company doesn't record income tax payable. Company doesn't record income tax payable, but they have income tax expenses of 1,273 million dollar in 2019. So, and in the question number 7, they showed like the income tax expenses showed in the income statement is 1,273 by in 2019, but the income tax paid is 1,515 million dollar. That's totally different because there is some formula. As per my research, there I've got the formula that income tax paid is equals to income tax expenses plus decrease or decrease in income tax payable or deferred tax liabilities, or minus increase in income tax payable or deferred tax assets, plus increase in deferred tax assets or minus in decrease in deferred tax asset. That's the formula, so we can get that answer. And question number 8, temporary differences that I have already explained above, and there's a permanent differences. So permanent differences are the ineligible taxes not overdue. Permanent differences. Okay, so some of the examples of the permanent differences are dividend receivable, donation, penalties and fines, etc. And in this report, the company has recorded a dividend received as a permanent difference of $28 million in 2019 and $49 million in 2018. So at the question number 9, I have found that the annual report that income tax has been decreases from 1,644 to 1,273. Yeah, okay, that's all. Thank you so much. Bye.